Hungary just made a political move that markets usually love and at the same time completely misunderstand. After 16 years of the same leadership, the entire political structure has flipped almost overnight. And we've already seen this exact setup play out before. Poland in 2023. On the surface, it looked almost identical. A political shift improving relations with the European Union and a wave of optimism from investors expecting capital inflows and stronger markets. And yet, the actual market reaction was far more complex than most people expected. So in this video, we are going to break this down properly. We'll start with what happened in Poland and what just changed in Hungary. Then we'll look at where the similarities end. And most importantly, how markets reacted in Poland, how they are reacting in Hungary right now, and what could that mean over the next few months. I'm Daniel, a former London stockbroker and worked in finance for 10 plus years. I also publish stock market analysis to numerous investing websites, and in addition, I host one of the largest investor conferences every year in Central Europe. And if you want to see more videos like this, hit that subscribe button. Let's start with Poland because this is the cleanest reference case we have. In 2023, Poland held one of its most important elections in decades. The ruling Law and Justice Party had been in power for 8 years with increasingly tense relations with the European Union. Billions of euros in EU funds were effectively frozen due to rule of law disputes. Then came the opposition coalition led by Donald Tusk. Pro-EU, more aligned with Brussels and crucially seen as a gateway to unlocking these funds. The election results didn't just change politics, it changed expectations. Suddenly, investors started pricing in something very specific: better EU relations, incoming capital, and a more stable regulatory environment. But here's where it gets interesting. Even though the opposition won, forming a government wasn't straightforward at all. There were internal divisions, presidential veto risk, and plenty of uncertainty about how quickly reforms could actually happen. In other words, politically messy, but directionally clear. Now let's move to Hungary because this is where the story becomes more dramatic. Viktor Orban's 16-year grip on power has ended with the TISA party led by Peter Magyar winning decisively. And just like in Poland, the narrative immediately shifted. Pro-EU government, potential access to EU funds, reset of relations with Brussels. On paper, almost identical to Poland. But there's a major difference. In Hungary, the previous government didn't just shape policy, it shaped parts of the economy itself. Certain companies, sectors, and ownership structures became closely linked to the political system. Several companies, even publicly traded companies, became part of the Orban regime with close political ties and profit that was entirely dependent on certain government contracts. For example, Opus, which is a publicly traded company, had interest in the energy sector, supplying gas to consumers, a typical sector where the Orban regime basically forced international energy companies to sell their infrastructure to Opus. But that is just one example. So when power changes, it's not just policy that shifts, it's capital flows inside the whole market. Now let's connect the two, Poland and Hungary, because this is where the real insight is. Both countries went through a similar political transition, from EU friction to EU alignment. Both had significant EU funds at stake, and both triggered the same initial investor reaction: optimism, capital inflows, and currency strength. But similarly, in narrative does not mean identical market behavior. Let's break down what actually happened in Poland's markets, because this is the blueprint everyone is now looking at basically. The WIG 20 index didn't wait for the election result. It started rising before the vote as investors anticipated a shift. Actually, the election was held on the 15th of October 2023, but the markets have started to rise from the 5th of October. Does that mean that markets have prediction powers, good prediction powers? Possibly yes. Then, once the outcome became clear, there was a sharp gap upwards. From there, the market continued climbing strongly into December 2023. But here's the twist most people miss. Does this mean that the upward market and market movement was due to only the election results? If you zoom out and compare Poland to the S&P 500, Polish equities were actually underperforming until the beginning of October. The S&P 500 year-to-date return from January to October 2023 was roughly around 13%, while the Week 20 return was only about 4%. Then suddenly, after the election, Week 20 started to climb aggressively while the S&P 500 declined until the beginning of November and then went on a sustained rally into April 2024 without any meaningful correction. So we can say that the election had a significant positive impact on the Polish stock market for about 2 to roughly 2.5 months. And the currency tells the same story, but in a more controlled way. The zloty strengthened gradually before the election, anticipating the results, just like the stock market, then continued strengthening into December. Before the election, the Polish currency was trading at around 4.5, 4.6 to the euro. Then after, it became stronger to around 4.35. However, after this initial and actually quite fast movement, the currency leveled off at around 4.3 and did not move much in the upcoming months. This is because the initial hype and enthusiasm fades away when the new government, obviously need to start working and new legislations are introduced. But this is very similar to any industry and any sector due to human behavior. Just have a look at what happened with the AI boom in the last 4 years. ChatGPT was introduced in November 2022. Everyone started trying it and companies realized that, hey, this is maybe the new gold rush. Nvidia shares have increased by 920% in the year and a half from January 2023 to June 2024. Then from June 2024 to today, the increase was only around 54%. So when the hype and enthusiasm is great, that is the period when the stock market goes up significantly. When the enthusiasm fades away, or at least not as strong as before, that's when the returns normalize. I believe that this is exactly what we have witnessed in the aftermath of the Polish elections. And this is why it's very interesting to look at Hungary right now. The Hungarian currency has already been strengthening since late March, even before the election results became public. That tells you the market was already positioning for a change. And after the election, the move accelerated with the currency strengthening from around 380 to roughly 360 to the euro. A significant move and importantly, a multi-year high. The story sounds familiar, isn't it? That's why I anticipate that the forint will not become significantly stronger in the upcoming months, but if the government does a good job, or relatively good job, it is likely to stay under 400 against the euro for the next 6 to 9 months. But equities are telling a more complicated story. Unlike Poland, where the rally was broad-based, Hungary is showing signs of internal divergence. That is purely because the number of companies that are in the index. Poland has 20 companies in its stock market index, and technically Hungary, yes, is similar, it has 16 companies in the index. However, 4 companies are responsible for 90% of the total index weight, so it's extremely concentrated. Despite this concentration, the fact remains true that after the election, the stock market went up in Hungary, just like in Poland. However, I'm not so certain about the next month's movements. Certain stocks, particularly those associated with the previous regime, are being aggressively sold off. Others are holding up or even benefiting from the new political direction. This is not a clean upward trend. This is sort of like a rotation. I strongly believe that those companies that are heavily related to the previous government, such as Opus, Appenin, 4IG, MBH Bank, will have very difficult times in the upcoming months. However, they are far from going bankrupt. But I would keep my distance from these companies, quite a far distance, even if it seems that their stock have fallen by 40, 50, 60%, because I'm not so sure about the future upside. And that changes how you interpret the market. In Poland, the story was the whole market retreats. In Hungary, the story might be part of the market get repriced while others get reset. That's a very different dynamic. Now, let's talk about what happens next, because this is where most investors make their biggest mistake. They look at Poland's rally and assume Hungary will follow the same path over the next few months. But markets don't copy-paste outcomes. There might be similarities, maybe quite a lot, but there will be differences as well. In Poland, the strongest move happened around the election and shortly after. Once the optimism became consensus, the easy gains were largely done. So what are the likely scenarios going forward? In the short term, you could still see continued strength in the forint if expectations around EU funds remain strong and capital inflows continue. But that move could slow down because currencies tend to stabilize once the initial repricing is complete. In addition, when the EU funds start flowing in, it is better to have a slightly worse currency rate exchange so you can get more forints for the same €1. It's better to exchange at 380 than at 360. In addition, if the central bank starts lowering the interest rate to perhaps restart the economy and reshape it, that also means a slightly weaker forint to the euro. For equities, the path is less straightforward. You could see a delayed broad rally similar to Poland if confidence builds and capital flows increase to all the companies that are not Orban related. But you could also see continued volatility, especially as investors reassess which companies benefit from the new political environment and which ones don't. And here's the key risk. Expectations might already be ahead of reality. Just like in Poland, the new government will face constraints. Implementation do take time. EU negotiations take time. Economic impact takes time. If markets have already priced in a smooth transition and a fast access to funds, any delay can trigger pullbacks. And if you want to understand how to position yourself around these political-driven market shifts, instead of reacting too late, subscribe to the channel and don't forget to hit the like button to help the YouTube algorithm. See you next time.